Welcome to Trading Smart, a trading education series designed to help you understand how the market really works. In this series, we'll explore the concepts used by professional traders, including market structure, liquidity, smart money behavior, and risk management. Whether you're a beginner or an experienced trader, this journey will help you develop a more structured and disciplined approach to trading. The financial markets are the same for everyone, but the way traders approach them can lead to completely different results. On the left, we have the typical retail trader. Retail traders often enter trades based on emotions such as fear, greed, and the fear of missing out. They react to the market instead of preparing for it. Many trade without a clear strategy, ignore risk management, and focus on short-term gains. As a result, their performance becomes inconsistent and difficult to sustain over time. On the right, we have smart money. Smart money traders approach the market with patience, discipline, and a structured plan. They study market structure, analyze liquidity, identify institutional activity, and wait for high probability opportunities before committing capital. Instead of chasing price, they focus on understanding why price is moving. Instead of reacting emotionally, they follow a process built on logic, data, and risk management. Notice the key differences. Retail traders react, while smart money prepares. Retail traders chase opportunities, while smart money waits for opportunities. Retail traders focus on quick profits, while smart money focuses on long-term consistency. The difference is not luck. The difference is knowledge, discipline, execution, and mindset. The goal of this Trading Smart series is to help you transition from thinking like the crowd to thinking like a professional trader. Same market, different mindset, different results. So, what exactly is smart trading? Smart trading is a professional approach to analyzing the financial markets by understanding how price moves, why it moves, and who is driving those movements. Most retail traders enter the market without a clear plan. They follow hype, trade emotionally, ignore risk management, and often become frustrated by inconsistent results. Smart trading takes a completely different approach. Instead of guessing market direction, we focus on understanding market structure, liquidity flow, institutional behavior, and high-probability trade setups. We learn to identify where smart money is active, where liquidity is resting, and where the market is most likely to react. Every candle, every breakout, every pullback, and every reversal leaves clues about what large institutions and professional traders are doing behind the scenes. Smart trading is built on 5 key pillars: structure, understanding the framework of the market; money flow, following liquidity and smart money activity; advantage, identifying high-probability opportunities; risk management, protecting capital and controlling losses; and trade execution, entering and managing trades with discipline and consistency. The goal is not to predict every market move. The goal is to make better decisions, manage risk effectively, and trade with a professional mindset. By the end of this series, you'll begin to see the market through the eyes of smart money rather than the crowd. Before we can understand smart money, liquidity, or institutional trading concepts, we must first understand market structure. Market structure is the framework that helps us understand the direction of price and the current condition of the market. Every movement in the financial markets leaves behind a series of highs and lows. By studying these highs and lows, traders can identify trends, potential reversals, and high-probability trading opportunities. On the left side, we can see an uptrend structure. An uptrend is formed when price continuously creates higher highs, known as HH, and higher lows, known as HL. This tells us that buyers are in control, and demand is pushing price higher. As long as higher highs and higher lows continue to form, the market remains bullish and traders generally look for buying opportunities. On the right side, we can see a downtrend structure. A downtrend occurs when price creates lower highs, known as LH, and lower lows, known as LL. This indicates that sellers are in control and supply is pushing price lower. As long as lower highs and lower lows continue to form, the market remains bearish and traders generally look for selling opportunities. Understanding these simple market structure principles allows traders to stop guessing and start trading with the flow of the market. However, markets do not trend forever. At some point, the structure begins to shift. This is where two important concepts come into play: break of structure, or BOS, and change of character, or CHOCH. A break of structure happens when price breaks a significant swing point in the direction of the existing trend. This often confirms trend continuation and shows that momentum remains strong. A change of character occurs when price breaks a key swing point against the current trend. This can be an early warning sign that market control is shifting from buyers to sellers, or from sellers to buyers. Professional traders pay close attention to these structural shifts because they often appear before major market reversals. Market structure also helps us understand the three phases of market movement. First comes accumulation, where institutions quietly build positions. Next comes expansion, where price begins moving strongly in one direction and trends develop. Finally comes distribution, where institutions begin taking profits before a potential reversal occurs. By learning to identify these phases, traders gain a deeper understanding of what large market participants may be doing behind the scenes. Remember this: structure is the map, price is the vehicle. If you can learn to read market structure correctly, every other smart money concept becomes much easier to understand. This is why market structure is the foundation of every successful trade.
Everything we teach is designed to build layer upon layer of professional trading knowledge. We begin with market structure, the foundation of all successful trading. You'll learn how to identify higher highs, higher lows, lower highs, and lower lows, along with critical concepts such as break of structure, known as BOS, and change of character, known as CHOCH. These concepts help us understand trend continuation, trend reversal, and market direction. Next, we'll move into smart money concepts. Here you'll learn how institutions use liquidity, stop hunts, order blocks, mitigation blocks, breaker blocks, and premium and discount zones to enter and exit positions. This is where you begin to understand how large market participants move price. After that, we'll explore price delivery concepts. You'll learn fair value gaps, imbalances, equilibrium, premium zones, discount zones, and optimal trade entry, often called OTE. These concepts help us identify areas where price is likely to react and provide high-probability trading opportunities. The fourth stage focuses on institutional behavior. You'll learn accumulation, distribution, reaccumulation, redistribution, market maker models, and institutional order flow. This allows us to see what smart money may be doing behind the scenes before major market moves occur. Once the foundations are in place, we'll move into professional execution. You'll learn multi-time frame analysis, trade confirmation techniques, risk management, position sizing, trade management, and professional trade journaling. This is where strategy becomes consistency. Finally, we'll combine everything with AI and advanced analytics. You'll discover probability-based trading, trade scoring systems, signal validation, dataset analysis, performance tracking, and institutional-grade AI models. These tools help transform trading from emotional decision-making into a structured, data-driven process. By the end of this roadmap, you'll understand not only how to read the market, but how to think like a professional trader. The goal is simple: to move from guessing to understanding, from reacting to planning, and from retail habits to institutional thinking. This is your path from beginner to institutional trader. Let's begin the journey.
Every successful trader starts at the same place, as a beginner. Trading is not a destination. It is a journey of learning, growth, discipline, and continuous improvement. Your trading smart journey begins with discovery. At this stage, you will learn the fundamentals of financial markets, develop the right mindset, and understand why most traders struggle to achieve consistent results. Next comes learning. Here, You will build a strong foundation by understanding market structure, smart money concepts, price action, fair value gaps, order blocks, and institutional trading principles. Knowledge creates awareness, but knowledge alone is not enough. The third stage is practice. This is where theory meets reality. You will test your skills through chart analysis, backtesting, demo trading, and structured risk management while developing confidence in your trading decisions. Once you gain experience, you will move into execution. This is where traders begin to follow a trading plan, manage risk effectively, control emotions, and execute trades with patience and discipline. The fifth stage is refinement. Professional traders constantly review their performance, analyze mistakes, improve weaknesses, and fine-tune their strategies. Growth comes from continuous improvement. Next comes scaling. As consistency develops, traders focus on position sizing, capital management, and building sustainable long-term growth while protecting their capital. Finally, we reach the stage of mastery. Mastery is not about winning every trade. It is about achieving consistency, maintaining discipline, thinking like an institution, and creating financial freedom through a proven process. Remember, every expert trader was once a beginner. Stay committed, stay disciplined, keep learning, keep improving, and most importantly, trade smart, because the best is yet to come. Thank you for watching and being part of the Trading Smart community. I hope today's lesson has helped you take another step toward understanding the markets from an institutional perspective. Remember, successful trading is not about finding a magic indicator or chasing the next winning signal. It's about building knowledge, developing discipline, managing risk, and following a structured process consistently over time. Every professional trader started exactly where you are today. The difference is that they committed to learning, improving, and never giving up when challenges appeared. If you found value in this video, please take a moment to subscribe to the channel and turn on notifications so you never miss future Trading Smart episodes. Each week, we'll be releasing new educational content covering market structure, smart money concepts, liquidity, order blocks, fair value gaps, institutional behavior, risk management, trade execution, and advanced AI-powered market analysis. Our goal is simple: to help traders move from confusion to clarity, from emotion to discipline, and from retail thinking to institutional thinking. You can also join our growing Trading Smart community through Telegram, WhatsApp, and Instagram, where you'll find market insights, educational content, updates, and discussions with like-minded traders. And now, get ready for our next episode, Market Structure Overview. In this lesson, you will learn how to identify higher highs, higher lows, lower highs, lower lows, break of structure, and change of character, the foundation of every successful smart money strategy. The journey has only just begun. Keep learning, keep growing, stay disciplined, stay focused, and as always, trade with intelligence, win with discipline, trade smart. See you in the next episode.